And what I want to do first is we're going to talk about the Home Safe Second program. That's a reverse mortgage second trust deed program. And before I talk about it, I want to show you this very quick video. It's only about 2 minutes, 40 seconds. So take a look at this.
Introducing Home Safe Second, a second mortgage that doesn't require monthly payments. It's a way to access home equity to improve cash flow without any impact on your current mortgage. Here's how it works. If you're a qualified homeowner age 55 and up, Home Safe Second can loan you a lump sum of cash based on factors like your age and your current amount of home equity. Unlike a traditional home equity loan or a HELOC, you're not required to make monthly payments. So instead of spreading out payments over a 10 or 20-year term, you pay back the loan and its accrued interest at the end, when you no longer live in the home. Home Safe Second is a unique and groundbreaking financial solution for those looking to weather economic uncertainty by offering greater benefits than a traditional HELOC. Let's take a look at why it may be right for you. Meet Susan. Susan took advantage of previously low rates to refinance her mortgage and solidify her monthly budget. But then inflation hit, and her monthly costs have grown out of control. Susan struggles to make her monthly budget, but her day-to-day costs are more expensive, everything from groceries to gas. She needs extra cash, but doesn't want to refinance her low-rate first mortgage. She could put her expenses on a credit card, but the rates could be extremely high and they require a monthly payment. The same thing goes for personal loans. And though a home equity loan like a HELOC has a more favorable rate, its required monthly payment would cut into the cash she needs. This is why Susan chose Home Safe Second. With a fixed rate, no additional monthly payments required, and no change to her first mortgage, Home Safe Second loans Susan a portion of her home equity, making her retirement budget more comfortable and putting her worries at ease. When Susan leaves the home, she or her heirs will be responsible for paying back the loan, which can be settled with the sale of the house, but will never amount to more than the home's value. Whether you want to cover rising costs like Susan, consolidate high-interest credit card debt, fund medical expenses, pay for home improvements, and more, Home Safe Second is a helpful solution for improving cash flow and reducing financial stress. Contact a home equity specialist today to learn more about how Home Safe Second can put you first.
The basic idea was profiling a homeowner where she meets the eligibility requirement of being over 55, but running into some issues financially in terms of the high cost of living these days. And of course, it explored the idea of what alternatives would a person like that have in terms of, getting more funds available to deal with the various aspects of the high cost of living right now, whether it be, increased cost of gas and groceries, improvements that need to be done to the home and so forth. So let me go ahead and show you a slide that I have where I'm going to just cover the bullet points of why this Home Safe Second program can be a really terrific program for you to consider if you're a 55 plus homeowner and you're running into some obstacles in terms of tapping into your equity when you need some funds for a variety of reasons. As you can see there, the slide says Home Safe Second. It's a little clever. Give your budget a second to breathe. Again, this is a second mortgage. So the idea here is, what can you use this for? Let me show you the bullet points. First of all, and I'm seeing a lot of this, people are over 55. They still have income, but maybe it's been reduced from what it used to be before. And they're, unfortunately, I'm seeing a fair amount of homeowners who have got quite a bit of credit card debt, and they're struggling on ways to get rid of that and reduce that very high interest cost. So this is a primary reason why this Home Safe Second can be beneficial to that type of homeowner. And of course, the next one, I mentioned it already, cover the rising costs at the pump and the grocery store. Although, frankly, more recently, we're seeing improvement in both of those costs. Gas prices are down. I think grocery store prices are down. Heck, I bought two cartons of 18 eggs, two of them for less than $6 at the market. So the old egg prices are too high thing seems to have subsided somewhat. The other big area where I think homeowners over 55 can end up struggling financially is funding long-term care, medical expenses, or just if they have an unforeseen emergency. A lot of homeowners, especially as you get into the older homeowners, not everyone has got a real good safety net in terms of savings to tap into. So, and if they have a lot of equity, it can be frustrating to figure out a way to access that. And then the next thing most common that we see is paying for home improvements. I'm talking to a homeowner now who meets the criteria in terms of being over 55. In fact, they're in the mid to high 60s, and they've got some issues. They got a lot of equity, like $800,000 worth of equity, but they need a new roof. They need their bathroom redone. They need some other things done to the home, and they are lacking the financial wherewithal to take care of that. They've got a low rate first mortgage, so they don't want to just refinance that. Plus the fact when they looked into getting a home equity line of credit, they didn't qualify, because those are actually pretty difficult to qualify for based on meeting a debt ratio. So why would the Home Safe Second be a good alternative for them? Well, first thing to know is you're not going to have any mortgage payments required. I want to underscore required. You can make payments on this loan if you want to, but it's a reverse mortgage type of a product. And even though it's a second mortgage, that means once you get the funds, you do not have to make payments unless you want to. And of course, why would you do that? Maybe because you want to avoid the interest costs being added to the balance and have that balance grow over time. When do you pay off the loan? You do have to pay it when you leave the home, just like a first mortgage, reverse mortgage. That usually means either because you've passed away, or in some cases because you have to exit the home and maybe go into long-term care. If that situation occurs and you're going to be out of the home for more than 12 months, that's considered leaving the home, and then you or your heirs are going to have to get this loan paid off. That doesn't mean you have to sell the home, but it does mean you have to figure out how to pay it off. You could keep the home and refinance it, if not yourself, your heirs, or you could sell the home. It's really going to be up to the family to decide what's the best way to repay this loan, whether you keep the home or not. Keep in mind, the loan balance, of course, will grow over time if you don't make payments. That's because the interest accrues back to the balance, just like a first mortgage, reverse mortgage. But you or your heirs will never be liable for more than what the home value is. So if you get one of these loans and you keep it for many years, to the point where maybe the home appreciation doesn't keep up with the growth of the second mortgage balance, and you end up in a situation, what we call underwater on value, not to worry. If you exit the home because you've passed away, your heirs are not going to be responsible for that negative balance. That is absorbed by the lender. It will not be absorbed by you or your heirs. And this loan is much easier to qualify for. You do have to have a 640 credit score, and you don't qualify based on the typical, debt to income ratio. So for that perspective, if you meet the credit score requirement, you got a lot of equity, you're over 55, you're running into trouble getting qualified, whether it's a cash out refi, or you have a first mortgage that's at 2 3/4, 3%, you don't want to touch it, but you can't get a HELOC because you're told you don't qualify. This is a great alternative. I would encourage anyone or if you are in this situation yourself, give me a call. I'd be happy to give you some numbers and show you how this can be very effective to address your financial concerns and get you a lot better place financially in terms of cash flow and money needed to cover any of these expenses we just discussed.